Joining us right now is Morgan Creek Capital Management CEO and CIO, Mark Yusko. Mark, it's good to see you this morning, as always.
Oh, great to be here.
You've been cautious. Going into last week, you were expecting a decline.
Yeah, look, we've been expecting that, earnings would not be as robust as people had thought after the great earnings of the second quarter. We thought the economic growth numbers were going to start to roll over a little bit, and this big deficit number is very concerning.
Do you think this sell-off continues then?
We think it will probably continue for a while. We don't think it's going to be a sharp correction. We think this is more of a rolling kind of bear market like we had in 2000, 2001.
But, Mark, you say the deficit number is concerning. It seemed for a long time like the market really wasn't paying attention to budget deficits.
Yep.
Is it now? And explain why it matters to the market and also to the economy that we're running increases in the deficit of 17% and heading towards $1 trillion.
Yeah, I think the biggest reason, John, it's a great point, is that we weren't paying attention to it because it wasn't really impacting interest rates. Interest rates were stubbornly low. They were staying down. Now, suddenly, they've ticked back up over 3% on the 10-year. The problem is when you have highly valued assets, which we have in the stock market, and you get a higher interest rate, you're discounting those future streams of cash flows at that higher number, your valuations need to fall. Your prices need to fall. So I think that's a big issue. A lot of numbers have been reported recently on the amount of money we're paying in interest. It's consuming a very large percentage of our deficit. And then revenues have started to tick down, which is a problem.
So I just want to break this down a little bit.
But I want to break it down. Because revenues, the reason that we did tax reform in the first place is so we do grow revenues faster. Because in the 2017 fiscal year, revenues only grew at 1%. And we suffered from lackluster economic growth through this entire expansion.
They grew less than that last year,
No,
revenue fell.
Less.
No, in 2017, revenue before the tax cuts was only growing at 1%.
And after the tax cuts, they grew less. They
right,
grew 0.4%.
but so you create the foundation, and in years ahead, revenue will grow faster.
So you think this is just a stabilization for the first year, and then revenue resumes growth after this year?
Right,
that might be the case, but we
right.
haven't seen it yet.
Right, we haven't seen it yet.
Revenues were essentially flat last year.
Yeah.
But what we're waiting for, I mean, what about that?
Look, I'm not a big fan of tax reform. I think it's a bad decision this late in an economic cycle to cut taxes. Normally, you're going to see revenue fall as economic growth slows. You add a lower tax rate to that, you're going to have a calamitous decrease in revenue with an increase in expenses with interest rates rising.
So just to be clear, you would have preferred that the corporate rate stay at 35%?
I would have preferred that we not cut taxes at this late.
Leave it at 35%.
Yeah.
Well, and
I don't have the details on numbers.
No, but that's what it was. It was 35%.
Yeah.
Yeah, so you mentioned valuations need to come down in this type of operating environment with higher interest rates, and I understand that point of view. But last week at the depth, the multiple on the S&P 500 was 15.9 times, which compares to a 5-year average of over 17 times. Now, so are you saying that earnings growth, it's already expected to be cut in half next year from the 2018 level of over 22%, we get 10% in 2019? Are you expecting numbers to be worse than that?
Couple issues. One, a lot of times people do this. They talk about forward multiples and 12-month multiples. The only multiple we know of is what actually happened over the last 12 months. When people start talking about forward multiples, it just makes me crazy, right? And the problem is we're all looking at a polluted data set. We're looking at the last 20 years. We had that big spike in 2000 where we went to never, never land of, 40 times multiples.
.com era.
And yeah, exactly. And so if you look at the whole history, forward earnings should be around 11.5%. When we're up at 17%, that's a big overvaluation.
But in some cases, the growth is there, right?
Sure.
And the expectations of growth have really met, the reality has met the expectation.
A market is a market of stocks.
Yeah.
And there are certainly opportunities in the markets where there are very cheap assets. You look at the bifurcation between growth and value. Value stocks are as cheap as they have ever been, as cheap as they were in 2000 when people were giving up on giving up on value, and value managers were shutting down their doors. We have the same problem today. We have the FANGs that are egregiously overvalued. Now, even within the FANGs, you got a couple of them that are really crazy, like Netflix and Amazon, and Facebook, which is down this year, and Google are still, I think, crazy, but not as crazy. Then you go down into some of the value stocks trading at 4 and 5 times earnings. I agree with you. There's opportunity.
Yeah.
And it's odd because usually you see value stocks do better at the beginning of a cycle, not this late in the cycle. So
They're not
Is that
doing
where-
better yet,
Yeah.
though. They're not doing better yet.
Yeah,
Well,
they're not
money's
doing
flowing
better
into
yet.
them.
And people are starting to look at relative valuation. I made this joke the other day that a friend challenged me to run this half marathon this coming weekend. And so I've been training, and I said in the high keto diet world and high protein, carbs are good for you. Now I need their carbs. I need the carb load. And if you look at carbs, China, Argentina, Russia, Brazil, South Korea, those are the places where stocks are really cheap. Now, they actually might get cheaper. If we get into a true bear market in the U.S., those will get cheaper. But they're already down a lot. Tencent down 40%, down much more than the big U.S. tech names, Alibaba, things like that. I'd go start nibbling in those places to buy what's on sale.
Are you arguing that we're entering a bear market in the U.S.?
I think we will see a bear market between now and 2020.
Bear market, 20% down from
decline.
the highs is a bear market. How do you justify a bear market given the backdrop? 4.2% economic growth, earnings growth 22% year over year for the third quarter.
Yeah.
Unemployment record
I think
lows.
it's a steroid shot. I think we got a steroid shot with in my opinion, an ill-advised tax plan. And so we had one quarter of good earnings, good GDP growth. I think GDP growth is going to be less this quarter. I think it'll be less next quarter. I actually think there's a potential for a recession in 2019 towards the end of the year. And I think earnings are going to disappoint going forward. And ultimately,
well, tell that
if you look
to
around
the Fed.
the world.
Tell that to the Fed. Yeah, go ahead.
Well, if you look around the world, stock markets are down. 80% of stocks are below their 200-day moving average. 80% of countries below their 200-day moving average. And we're the only country that really has continued to go up, where the rest of the world's in a bear market.
So are you saying we're going to an economy that's slowing down or going into a recession? And if you're saying going into a recession, what drives the U.S. into a recession? Where are the excesses now that would cause that kind of thing?
Look, I don't think we're in a recession. I don't think we're close to a recession. I think it's possible for a recession in 2019. Where I see it coming from is the decline in global trade. One thing we know is over time, global trade leads global profits, which leads global stock prices. Global trade is collapsing, absolutely collapsing. I mean, it's negative for the first time, not even lower, positive number, like you said about GDP. I mean, about tax revenues, but it's actually a negative
Is
number.
it just with China, or it's collapsing across the board?
Everywhere. And it's a combination.
We just did those deals, though. I mean, Canada, Mexico, South Korea, Europeans.
Yeah, but this is Europe trade with us and with China. It's China trade with Southeast Asia. It's everywhere you look, and it's because of these nationalist and populist movements. Not just it's everywhere.